$57.9 trillion.
Yeah, that's a big one.
I mean, I really want you to just let the sheer gravity of that number sit in your head for a second. 57.9 trillion. That is the exact amount of assets under custody and administration held by the subject of today's deep dive, which is State Street.
Right.
We're jumping right into their Q2 2026 earnings report today, pulling directly from the official release and their financial highlights presentation.
Yeah, and the mission here is to really look under the hood of one of the world's largest, yet somehow most invisible financial giants.
Seriously, they're everywhere, but you never see them.
Exactly. We want to see how they are turning all this global liquidity into record-breaking revenues. Because it's a number so large, it effectively represents a massive chunk of global capitalism just, sitting under one corporate roof.
Right, because when most people think of a bank, they picture consumer retail operations like checking accounts and ATMs.
Yeah, but State Street operates on an entirely different plane. I mean, they are the plumbing of the global financial system.
Yeah. They're the ultimate vault. They aren't lending out mortgages to home buyers. They are holding the assets for sovereign wealth funds, massive pensions, global asset managers. Right?
Keeping the definitive global ledger of who owns what.
Exactly. And that is exactly why we are digging into this. Because even if you never interact with State Street directly, if you have a 401k or a pension or even just an ETF allocation, they are almost certainly securing, accounting for, and processing the trades for your money.
Which means their operational health is directly tied to the systemic security of global retirement assets.
So we should probably care how they're doing.
We definitely should. And while their operational health in Q2 was nothing short of historic, looking at the scoreboard, that $57.9 trillion in assets under custody and administration, or AUCA, that's a new record. It's up 18% year over year.
Wow.
And we also need to look at their assets under management, the AUM. This is the capital they were actively managing themselves through State Street Global Advisors.
Right.
That hit a record $6.3 trillion, which is up 23% year over year.
Okay, so translating that sheer scale into actual corporate performance, the bottom line is frankly stunning for a legacy custodian. I mean, earnings per share came in at $3.65, which is a massive 44% year-over-year jump.
44%, yeah.
The total revenue hit $4.0 billion, up 17%. But, this is where I have to look at the macro environment and play devil's advocate for a minute.
Sure, go for it.
We know global equities have been on a massive tear recently. So if you operate a giant vault and the assets inside automatically appreciate by 20% just due to market dynamics, your fee base naturally inflates.
Oh, totally.
So looking at these numbers, how much of this is State Street actually winning new mandates versus just passively riding the coattails of a global bull market?
Well, any analyst looking at a custodian bank's earnings immediately tries to isolate that market drift from the actual organic growth.
Right.
The market tailwind undeniably provided a significant lift, there's no ignoring that. However, the data in the Q2 presentation points to a sales engine that is running incredibly hot, entirely independent of market appreciation.
Okay.
In the asset management division alone, they pulled in $114 billion in net inflows for the quarter.
Okay, wait, so that is $114 billion in fresh net new capital actually walking through the door, not just asset inflation.
Precisely. And on the custody and servicing side, the numbers are even more aggressive. They secured a staggering $384 billion in newly awarded servicing wins.
Oh, wow.
Yeah. And the presentation notes that the bulk of these wins came from asset managers and alternative investment funds.
I really want to pause on that $384 billion figure because anyone who works in institutional finance knows the sheer friction involved in changing your back office custodian.
It is a nightmare.
Right. You don't just migrate hundreds of billions in alternative assets on a whim. The RFP process, the systems integration, the legal and compliance hurdles, it is a monumental undertaking.
It takes years sometimes.
Exactly. So for State Street to pull $384 billion away from competitors or secure it from new fund launches, that shows they are wielding a serious structural advantage in their tech stack or maybe their pricing.
Yeah, and it creates an incredible runway for future revenue, too. The report explicitly highlights that they have $335 million in servicing fee revenue just sitting in the pipeline, waiting to be installed.
That's huge.
Yeah, so the bull market is a nice multiplier, obviously, but they are actively expanding the physical footprint of the vault.
All right, so securing the assets is step one, but simply sitting on a mountain of capital doesn't magically generate $4 billion in a single quarter.
No, you got to monetize it.
Let's break down the actual revenue engine. What are the specific mechanisms State Street is using to extract that cash?
Well, it generally splits into three primary fee categories. First, you've got the core servicing fees. This is essentially the rent they charge for safeguarding the assets, handling the daily accounting, and processing all the administrative red tape. That segment generated a record $1.468 billion, up 13% year over year.
Wow, just the rent. And then you have the management fees from State Street Global Advisors, right? Running their massive suite of SPDR ETFs and mutual funds.
Exactly.
That hit a record $772 million, up an impressive 29%.
And the third major pillar is net interest income, coming in at $860 million, up 18%.
You know, that net interest income jump is fascinating to me because of how they achieved it. The report notes their net interest margin expanded by 17 basis points to 1.13%.
Right.
In a macro environment where the yield curve has been incredibly complex to navigate, squeezing out an extra 17 basis points of margin means their treasury team is hyper-optimizing the spread between the yield they generate on client cash and the interest they actually pay out.
Yeah, it points to very deft balance sheet management, particularly in how they are handling their deposit mix across different global rate environments.
Yeah.
But beyond the passive fees and those interest spreads, their active transactional operations are where the scale truly becomes a weapon.
I always conceptualize this part of their business as a massive global toll booth.
That's a great way to look at it.
Yeah, they charge you the baseline fee to park your assets in the vault, but the real upside comes because they charge a toll every single time you need to move, convert, or leverage those assets.
Right, and the foreign exchange trading desk is the perfect example of that toll booth mechanism.
Right.
State Street isn't just warehousing securities, they are facilitating the cross-border flow of capital.
Right.
When a massive sovereign wealth fund in the Middle East decides to reallocate a few billion into U.S. tech equities, they have to convert that currency. State Street executes that trade, and they take a slice of the spread.
And at a $57 trillion scale, those tiny fractional slices aggregate into a massive revenue stream. I mean, their FX trading services hit a record $494 million this quarter.
It's incredible.
That is a 27% increase year over year if we exclude some of the notable items from last year's comp. And I actually noticed the report specifically attributes this surge to heightened client volumes in the Asia-Pacific region.
Yeah, the APAC region has seen significant volatility and shifting capital flows recently, which drives trading volume. As global markets become more fragmented and institutional funds move across borders to chase yield, State Street captures that volatility premium.
Makes sense.
The more the water sloshes around in the pipes, the more tolls they collect.
The other transactional toll booth that really jumped out to me is securities finance, which grew 19% to $150 million.
Oh yeah, that's a big one.
For those tracking the institutional mechanics, this is when State Street acts as the intermediary to lend out the dormant stocks and bonds just sitting in custody.
Usually they lend them to hedge funds or prime brokerages that need to borrow the asset, often to facilitate short selling or complex arbitrage strategies. The client who owns the underlying asset gets a nice yield boost, and State Street takes a cut for administering the collateral and managing the risk.
And the report specifically cited higher client lending balances, driving that $150 million. That tells me two things. One, clients are actively seeking ways to squeeze extra yield out of their portfolios.
Definitely.
And two, there is robust demand on the other side of the trade from funds needing to borrow those securities. It's a highly lucrative, low-risk way for State Street to monetize the assets just sitting on their ledger.
It highlights how robust the core legacy business remains, honestly. But, you know, a company rooted in the 1700s doesn't survive by resting on its legacy plumbing.
Very true.
The financial landscape is shifting toward blockchain and distributed ledgers, and State Street is aggressively positioning itself for that transition. The presentation actually notes they launched 38 new products and solutions in Q2 alone.
And the standout among those 38 has to be their push into digital assets. They announced a tokenized fund servicing capability based out of Luxembourg, and they've already onboarded their initial client.
They also noted expanded access to tokenized liquidity solutions.
Well, Luxembourg is the undisputed regulatory hub for European investment funds, so planting the flag there is highly strategic.
Right.
And the mechanics of what they're doing here are critical to understand. They aren't just holding Bitcoin on a balance sheet. They are building the administrative architecture to support tokenized traditional assets.
Right, like taking a standard money market fund and issuing it as a digital token on a blockchain,
Exactly.
which completely changes the operational reality. A tokenized fund isn't just a digital PDF sitting on a server somewhere. It operates via self-executing smart contracts. The settlement is instantaneous.
Yep, it's immediate.
But for institutional capital to actually utilize those tokens, they still require an irrefutable, trusted entity to verify that the off-chain reality actually matches the on-chain token.
Yeah, right, someone has to vouch for it.
And State Street is stepping in to be that oracle. They are proving they can custody the cryptographic keys and administer the blockchain ledger just as effectively as they manage traditional equities. They are ensuring that when the financial system fully migrates to Web3 architecture, the plumbing still routes through State Street. It is a brilliant defensive move that also opens up entirely new revenue lines.
Speaking of securing massive pipelines of capital, there is a very specific product selection mentioned in their investment management updates that acts as a huge structural tailwind.
Oh, right, the SPYM thing.
Right. The U.S. Treasury selected the State Street SPDR portfolio S&P 500 ETF, ticker SPYM, as the exclusive default investment for the Trump Accounts program.
Yes.
And just to pause here, we must report this fact purely objectively as a business win noted in the Q2 earnings. We want to ensure you, the listener, understand we are impartially conveying the contents of the source material without taking any political stance or endorsing the program.
Absolutely. We're just looking at the business impact here. And securing an exclusive mandate as the default allocation for a government-administered program is one of the most coveted wins in asset management.
Yeah, because behavioral economics essentially guarantees the asset flows here. The vast majority of participants in any large-scale automated program never manually change their allocation away from the default option.
They just set it and forget it.
Exactly. So by securing that placement for SPYM, State Street has locked in a systematic recurring stream of new capital that will mechanically flow into their AUM quarter after quarter, generating a highly predictable management fee baseline.
It is the definition of sticky capital.
Yeah.
So, all right, we've established that the revenue engine is firing on all cylinders, bringing in $4 billion.
Yep.
They are winning organic mandates,
Yeah.
monetizing the volatility, and securing future flows. But the true measure of a management team is how effectively they translate top-line revenue into bottom-line profit.
Which brings us to the most impressive metric in this entire Q2 report.
Oh, it's the leverage.
Yeah, total expenses for the quarter came in at $2.659 billion, which is only a 5% increase year over year.
Right.
When you contrast that 5% expense growth against their 17% revenue growth, the resulting operating leverage is just phenomenal. They generated 1,226 basis points of operating leverage.
That's huge.
And even if we strip out the one-time notables for a cleaner look at the core business, they delivered 645 basis points of positive operating leverage.
Achieving a 645 basis point spread between revenue growth and expense growth is incredibly difficult for a massive financial institution.
It's unheard of for some of them.
It means they are scaling the business without a linear increase in overhead.
And doing it in an environment where wage inflation and technology costs have been a significant headwind across the banking sector. The sources outline how they actually pulled this off.
Right.
Productivity savings, optimizing their real estate footprint, and crucially, lower headcount. They are processing a record $57 trillion in assets, managing more complex tokenized products, and handling higher trading volumes, all while shrinking their physical footprint and reducing the number of people required to run the machine.
They did see higher performance-based compensation, which is to be expected given the 44% EPS growth.
Sure, you got to pay for performance.
But they entirely absorbed those higher bonuses through the structural savings in real estate and staffing.
The resulting efficiency metrics are just elite. They posted a pre-tax margin of 34.3%.
Wow.
That means for every dollar of revenue flowing through the toll booth, they are keeping over 34 cents in profit before taxes. More importantly, their return on average tangible common equity, the ROTCE, hit 25.5%.
Generating a 25.5% return on tangible equity proves they are deploying their capital with ruthless efficiency. The business model isn't just large, it is optimized to generate cash.
And management is turning around and handing that cash directly back to the market. They returned $631 million to shareholders in Q2. That breaks down into a $400 million share repurchase program and $231 million in common stock dividends. But the headline that really signals their internal modeling is the dividend hike. They declared a 10% increase to their third quarter dividend, pushing it to 92 cents per share.
A double-digit dividend increase is perhaps the strongest forward-looking signal a bank's board can send.
Right.
Because, share buybacks are flexible. Management can throttle them up or down depending on market conditions. But cutting a dividend is catastrophic for a bank's valuation.
Yeah, you don't hike a dividend by 10% unless your internal stress tests show that your forward cash flows are absolutely bulletproof.
Exactly.
It is a massive flex of balance sheet confidence. They are telling the market they view this current level of profitability not as a cyclical pick, but as the new permanent baseline.
And their updated guidance explicitly reinforces that confidence. Because of the sheer momentum in the first half of the year, they actually upgraded their full year 2026 outlook.
Oh, right.
They raised their fee revenue growth expectation to roughly 12 to 13% year over year, and they bumped their net interest income growth forecast to a robust 14 to 15%.
So they clearly see no signs of the engine cooling off in the second half. But the presentation also details their medium-term targets, extending out to 2029. And this is where we see exactly how they plan to maintain that incredible 645 basis points of operating leverage.
Right, the AI transformation.
It all centers on their tech and AI-enabled transformation.
Because in the custody banking world, the ultimate bottleneck is unstructured data. They have to process, reconcile, and verify thousands of complex, bespoke legal documents, partnership agreements, and alternative fund structures across dozens of jurisdictions.
Sounds like a lot of paperwork.
Historically, that required armies of back-office analysts doing manual reconciliation. It's incredibly slow.
It's the friction of legacy finance. But they're deploying AI to fundamentally alter that cost structure. I look at their AI implementation like a universal translator.
Oh, it's interesting.
Yeah, it can instantly ingest a 200-page Cayman Islands private equity contract, parse the bespoke legal clauses, and standardize that data into State Street's global ledger without a human ever touching it.
And that automation is exactly how they are targeting roughly $1 billion in annual run rate transformation benefits by 2029.
$1 billion in annual impact is a massive structural shift. The presentation breaks that down into two buckets. $750 million will come from pure productivity savings, so processing the data faster, with fewer errors, and with a significantly smaller human workforce.
Right.
But the remaining $250 million is projected to come from new revenue.
That new revenue component is critical. By unsiloing all that unstructured data and running it through advanced analytics, State Street can offer its institutional clients predictive insights, enhanced risk modeling, and real-time liquidity analysis that competitors simply can't match.
Ah, I see.
The AI doesn't just cut costs, it creates a premium product tier that attracts new assets.
It creates a flywheel. The AI allows them to process more assets at a lower marginal cost, which widens their margins, allowing them to invest more in the tech stack, which then wins them more mandates, like that $384 billion we discussed earlier.
Exactly.
This technological leverage is exactly how management plans to hit their medium-term targets of sustaining a 35% pre-tax margin and a mid-20s ROTCE.
Looking at the entirety of this Q2 2026 report, the overarching narrative is flawless execution of scale. State Street is proving that when you combine a $57 trillion asset base with aggressive technological automation, the resulting profit engine is formidable.
Highly formidable.
They're actively expanding their market share, maximizing the yield on the assets they hold, and driving down their operational costs in an inflationary environment.
It really reframes how we should view the plumbing of the financial system.
Yeah.
It isn't a stagnant utility. It is a highly optimized, high-margin technology platform.
Yeah, well said.
And that matters to anyone holding financial assets. The efficiency and modernization of State Street directly reduce the systemic friction in global markets, which ultimately protects the integrity and the cost structure of the retirement funds and ETFs that millions of people rely on.
A stronger, more efficient custodian creates a more resilient market architecture for everyone.
Right.
But as we look toward the future targets and their aggressive push into tokenization, this deep dive leaves us with a fascinating structural paradox to consider.
Oh, definitely. The original philosophical premise of blockchain and digital assets was decentralized finance.
Yeah.
The goal was to eliminate the massive centralized intermediaries and allow peer-to-peer asset transfer.
Yet, as the technology actually matures and institutional trillions prepare to enter the tokenized space, that capital demands the ironclad security and regulatory compliance that really only a legacy institution can provide.
Right. So the provocative thought to leave you with is this. As the financial system transitions into a brave new world of smart contracts and tokenized liquidity, will the centuries-old, highly centralized custodians like State Street be the ones to ultimately capture, secure, and control the supposedly decentralized future of finance?
It's a great question.
The plumbing is definitely changing, but the plumbers might just end up with more power than ever.